with no further ado, I would like to get us going here on a quick round of some Q&A. So I have a total of 16 questions for you, 16 items that are all going to touch on slightly different elements or issues within the industry. And these are just good proxies for the kinds of questions that you may run into on your actual SIE exam. These are not actual exam questions. We don't know what those questions are, but these are good ideas to be thinking about as you proceed. So why don't we go through them one by one? I will ask you for your answers or your responses to the questions. Just use the chat pane, the question pane, and you can just simply type me your letter answer, A, B, C, or D. And if you want to keep a little scorecard for yourself on kind of how you're doing with these questions as you go along here, that'd be great. Okay, so we'll get a sense of where we are and kind of how you're doing here. All right, so let's jump in. Let's take a look at this first question, guys. All right, and the first question says, an investor holding a muni bond with call protection would be most satisfied when what is happening? Interest rates are rising and bond prices are falling, or is it when interest rates are falling and bond prices are rising? Or is it happening when the economy, this is your happiness factor now, economy enters into an inflationary cycle? Maybe. Or what about the possibility of the yield curve assuming an ascending position? An ascending position. So let's take a couple of, let me know what you're thinking about this. Is your final answer to this one A, B, C, or D? Vote now. What are you guys thinking? So remember, it's about call protection. Call protection. So what does call protection really refer to? Call protection means that the issuer, you have a bond that is callable, and the bond is likely to be called. If you're the issuer who just borrowed $1 billion, you would call in bonds as interest rates are going down, correct? A bond is more likely to be called when rates are falling, not when they are rising. Because as any other borrower of money, you are likely to refinance this obligation, whether it's a bond issue or whether it's a home mortgage. You have borrowed money from a bank. Now, as interest rates have come down, the good news there is that you could refinance that debt by paying off the more expensive bond and replacing it with a cheaper bond, meaning a bond that has a lower interest payment. Now, in some cases, bonds have this feature known as call protection. And what call protection literally refers to is that for a specified amount of time, the issuer is actually legally not allowed to call those bonds. There's a window of time, typically from issuance, when a bond is not allowed to be called. So that would be good news to an investor in what environment? When rates are going up, when rates are going down. So the answer we're going for here, going once, going twice, yes, it's when rates are falling. When rates are falling. When rates are falling and bond prices are rising. That's where you as the investor are probably a little bit more happy that you've actually got this idea, you've got this notion of the call protection, because now as interest rates are going down, you know that the issuer is unable, he's legally prevented from calling in your bond. You can continue enjoying that higher stream of interest income than what current market conditions would otherwise provide for. Meaning if new bonds are coming out now, if rates have gone down, the issuers of those bonds would only be able to sell them at those lower interest rates, not the higher interest rates, okay? You know, the way I always think about this is issuers love lower rates, but investors love higher rates, right? You want to earn as much money on your returns on your investment as you possibly can. Okay, so that was the first question. So did you get that one correct?